Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
Disinflation versus deflation, momentum versus fundamentals, price versus earnings. Today's episode is all about contrasts. We discuss the diverging economic fortunes of the US and China, momentum trading pulling valuations away from fundamentals, and the stagnant Aussie market. Greg then explains why commodities still offer long-term value, exploring some unloved but enticing mining services stocks. And finally, when the market gets dull, pick up a book. Hello and welcome now to the 12th episode of What's Not Priced In. I'm Kirill Prakapenka, and joining me as always is Greg Canavan. Greg, good to see you.
Kirill, how you going, mate? G'day, everyone.
Not bad. Well, sometimes I like to start off with a bit of a quote. You know how much I like quotes. So today, following the mini tradition, I've got two short ones for you. One is from Stephen Penman. He's a finance/accounting professor, and he's got a good one on valuation, which sort of ties in nicely to valuation episode we did a few weeks ago, so do check that out. Anyway, this is what he said. Valuation is not a game against nature, but a game against other investors, and one proceeds by first understanding how other investors think. As an investor, you are not required to establish a valuation, but only to accept or reject the valuation of others. And this is the final one, and this one is actually from a famous horse racing punter, Stephen Christ, so that's a bit of a the curveball there. And he said, the issue is not which horse in the race is the most likely winner, but which horse or horses are offering odds that exceed the actual chances of victory. The only path to consistent profit is to exploit the discrepancy between the true likelihood of an outcome and the odds being offered. And I think that sort of ties nicely the whole ethos and philosophy of this podcast of What's Not Priced In. So there you have it. Yep.
I got a good mate who is a punter. He loves a Saturday punt, and we were talking the other week, and I actually said to him, "It's not a lot different to the stock market. You're just assessing odds basically and probabilities." And we talked about that in that valuation episode. It's all about putting probabilities on your side. And the first quote, we actually haven't discussed in detail what we're going to be talking about today, but that first quote will play into something that I do want to discuss, just about markets in general in a little bit as we get into the convo. So there you go. Well done.
No, that's nice. That's good. Well, I think we'll obviously some of the biggest news this week are some pretty disappointing economic data out of China, and obviously the upcoming US CPI data, which will be released tomorrow. We're recording this late Thursday. So I think we'll just maybe start off the discussion there with China and the US. And I think they're facing quite disparate outcomes. I think the US central bank is sort of struggling to keep to sort of tame inflation, so they're achieving disinflation. Whereas I think China now has a bigger problem, which is deflation, actually falling aggregate prices. So why don't we maybe start off there?
Yeah, sure. So I guess the data that has come out this week shows that the Chinese economy is slowing and is in a bit of trouble. Not necessarily drastic trouble, but whenever China slows down like this, you get more calls for where's the stimulus. The central, the authorities have got to do something. But we've spoken about this before, and I think if they were going to do something, they would have done it by now. And what they're very mindful of is creating a stimulus package that effectively stimulates all the wrong areas, which is what they're trying to wean their economy off. It would actually be useful, I think, for us to find someone who's really in-depth watcher of the Chinese economy, because it is very complex. I look at it from a very high-level perspective of past stimulus has created fixed asset investment boom, which has obviously been good for iron ore and Aussie commodities. But that is certainly the model of the growth model that the government's trying to get away from, because it's an unsustainable model. It creates all sorts of distortions. But in saying that, it's not easy to get yourself out of that. So I think targeted stimulus measures will come, but they're not
Mm-hmm.
going to be this big credit-induced boom that will just lead to more overinvestment in property and fixed asset type things. But if we just have a quick look at some of the data that came out
Mm-hmm.
this week, I think for me the really interesting stuff was the import export data.
Yep.
And if we look at it here, if you can see that on your screen, Kirill,
Mm-hmm. Yep.
we've got exports year on year in July were down 14.5%. Imports into China were down 12.4% year on year in July.
Mm-hmm.
And so that's just 1 month. And sometimes monthly data can be a
Yep.
little bit skewed. So if you look at year to date exports, they're down 5%. And year to date, so for the first 7 months of the
Mm-hmm.
year, imports are down 7.6%. And turning to the biggest markets for China, the US, exports to the US are down quite a large
Yep.
18.6% year to date, and exports to the EU down 12.1% year to date. And I thought, interesting from the Aussie perspective, imports from Australia, so obviously mostly commodities, up 9.5%
Mm-hmm.
year to date. So still looking reasonably good there from an Aussie perspective, but more broadly, those numbers really suggest that the global economy
Mm-hmm.
is slowing, just in terms of the trade aspects. And then if we look at the China CPI, which is Consumer Price Index versus the Producer Price Index, just dipped into negative territory here,
Mm-hmm.
and obviously quite running at a very year-on-year negative rate of 4.4% for the Producer Price Index. You could argue that this has probably bottomed. Like
Mm-hmm.
I wouldn't suggest that China's going into any sort of drastic deflationary period, but what
Mm-hmm.
it is suggesting is that growth is weak in China, and the global economy is certainly not helping China. So
Mm-hmm.
obviously China's the manufacturer to the world, weakening demand in the US and Europe is having an impact on its manufacturing sector. And I think the offsetting growth in the services sector in those economies isn't of much of a benefit to
Mm-hmm.
China. So I think that is, I guess, an interesting perspective from when you think about asset markets, when you think about stock markets.
Mm-hmm.
The global economy is slowing and is not in a particularly healthy state. And if we think
Yep.
about all the interest rate rises that have gone on over the past 12 to 18 months, and as we constantly talk about on this podcast, the lagged effect of those interest rate rises will still play out for the remainder of this year. And I think we'll continue to see the evidence of a slowdown. You mentioned before the US CPI.
Mm-hmm.
Now that is due to come out overnight. So by the time people are listening to this, that number will have been out. The expectation is that the US inflation rate will pick up a little bit this year.
Mm-hmm.
The next result, purely because of the base effects from last year.
Yep.
But if we look at some of these other numbers here, and this popped up on my Twitter/X feed last night. So off the recent lows, here are all the various commodities that have
Mm-hmm.
rallied since the start of the year. So not that this necessarily feeds into inflation directly,
Yep.
but it is something that you look at and think, well, there's still a fair bit of inflationary impact around in the commodity world.
Mm-hmm.
And if we have a look at the break-even inflation rate, which is the financial markets way of predicting or guessing what the average inflation rate is going to be over the next, in this case, 5 years. So the
Mm-hmm.
5-year break-even inflation rate is sitting at 2.23%, whereas on the 1st of June it hit a low of 2.07%, which was back here. So it's been increasing over the past few months, which I think has a bit to do with the change in commodity prices and especially
Mm-hmm.
energy prices. I'll show you a chart of oil in a moment. But even on the 10-year inflation front, it hit a low of 2.1% back in March, and this was when the Silicon Valley Bank and those banking issues happened in the US. But since then, it's been creeping higher, and really in the past probably few weeks, it's jumped up again. So the 10-year inflation break-even rate is rising. So there's I guess, a bit of concern that even though things are slowing, you're getting structural inflation coming back into the economy. Now, what I would say, if the US inflation rate surprises on the upside overnight, that threatens to lead to a lot of selling in the US bond markets, which I think will then lead to a lot of selling in the equity market as well. So if you think that the rally in US stocks has been all about slowing inflation over the past 6 to 8 months, and that's pretty much what it is. The inflation peaked in September, and that's when the market bottomed. And ever since then, the market has been rallying on the basis of inflation has been slowing and isn't so much of a problem. If the market starts to question that narrative, then I think you're going to see bonds and equities sell off, which would be a pretty nasty combination. If it comes in around expectations or even a little bit lower, I don't think you're going to see much in the way of fireworks, but that's certainly something to consider. I'll just quickly move on to the oil price just to show you how it's picked up there. We did zoom in on this last week. So really from late June, when this is Brent crude, so this is the international oil benchmark. Brent was around the $70 mark, and then recently it's popped up to $87. So it's had a really big rally in the last couple of weeks, and that has been the driving force behind this move up in this is the Thomson Reuters CRB commodity index. So there's a very broad commodity index where energy has the highest weighting. But we've seen it sort of bottom here, and we're moving out of that long corrective period. And that, I think, is concerning for inflation, concerning for the bond market, and certainly concerning for the equity market, given where the issues we've spoken about in recent episodes around valuation and things like that. So I will stop sharing my screen.
I've got a few. I've got maybe a few questions. I think maybe with China, I think maybe a question that somebody might have is, clearly China's struggles to jumpstart its economy have been well known and obviously well documented. It's plastered all over the major financial press. And so maybe the question is, are China's struggles therefore well and truly priced in, do you think, in your view? And are they maybe already reflected in the prices of commodities like iron ore and copper?
Quite possibly. Let me just show you because we've done this previously where we've looked at copper versus the Chinese yuan. So I'm not sure if you can see that on your screen just yet.
Not yet.
All right, let me have a look. All right, how about now?
Yep.
So the Chinese yuan to US dollar exchange rate is in the black here, and the iron ore price is in green. So it's a pretty good relationship over time between the yuan and iron ore price, and there is still a bit of a gap there. Iron ore has obviously sold off in the last couple of weeks, and I think there is probably still some downside risk. This is the area where the market started to think, okay, we're probably going to get some stimulus soon. And I think the iron ore price tried to anticipate that. So if that stimulus doesn't come through, then that isn't priced in. And I think that there is still some more downside there. So in answer to your question, it probably depends on which sector and where. But more broadly, I don't think markets, and perhaps we can just chat about markets in general. I don't think markets are really focusing too much on economic growth. If we think about and this goes back to your point, or the first quote that you made. So I'll just show a chart of the ASX 200 while we have this chat, because really this is a market. What are we? 10th of August today. We're recording this on the 10th of August today. The market peaked on the 13th of August 2 years ago. So we have pretty much gone down, up, sideways, nowhere in 2 years. And certainly this year we've hit a peak early February, and we've made lows in March, and we've just sort of gone sideways and not done a lot. And I think for investors, sometimes you can get very impatient with this type of market, and you can think, well, I must be missing something. I may as well just, jump on board and get involved because the market's not coming down to where I think it would be, or whatever. So the important thing to understand is that not everyone's a value investor, or not everyone invests in the same way that you do. And certainly in today's modern markets, most buying decisions are driven by machines and algorithms. And, we've talked previously about the money behind the tech stocks in the US, and everyone, I listen to, investor podcasts, and everyone's talking about, if you're not exposed to these 7 big stocks, then you're missing this huge move, and you're underperforming the market. And what happens in a lot of situations is that once stocks start to trend, these trend following momentum leveraged funds will just jump on that trend. They don't care about valuation. They don't care about anything else apart from whether that trend is still running or not. And that's why markets build up such a head of steam. That's why prices go well beyond what you think they can do, purely because everyone just jumps on board. And especially, I think in this market that is still driven by machines and different leverage trading strategies, that just means that you have to be patient, and you have to wait for the valuation to come to you, in terms of, what stock are you looking at, what do you think a fair value is, and what price should you pay for it. So I'm not necessarily saying you have to wait for the ASX 200 to fall back to these lows, or fall even further down here to last year's lows. That could happen. I don't know. I'm just saying that you need to consider that sometimes in the market, people are investing with completely different principles than what you are. And just because those prices don't suit you, it doesn't mean you have to just throw in the towel and say, well, I better jump on board in case I miss the train. You've just got to be patient. And I think if you look at the tech stocks, and we spoke about this last week, I think we maybe had this conversation when Apple was just here before it broke lower. We pointed out that the momentum was faltering. I won't show it today, but we showed the RSI index and how it had diverged from price. And we said that was a warning sign. So that sharp fall suggests to me that a lot of the momentum traders are starting to get out. Now, it's still holding around support. This is the 100-day moving average. So it sliced through the 50-day. Now it's sitting on the 100-day. Maybe we get a bounce from here. But to me, this is a big concern, in that there is so much money in this stock that doesn't care about valuation. It cares about momentum. And if we look at Microsoft, it's a similar story. You've got breaking above the old highs. It's rejected those highs. Again, we showed divergence between price and RSI last week, and now it's starting to falter again as the momentum traders get out of there. So it hasn't come back down to this support level as Apple has, but it certainly, it looks to be on the way. And I'm not saying it has to happen in the next 3 days, but we might get a bounce but to me, this the peak momentum is over for a lot of these stocks. Same with Nvidia.
Yep.
Big divergence here between price and momentum, and that's starting to sell off. Again, it's stretched a long way from the moving averages, so it's got a long way to come back to support. But it's another sign that the momentum traders are starting to get a little bit concerned. And then if we look at the FANG index, which is the 10, I guess, most popular tech stocks, that's popped up here. It's rejected those highs and is starting to sell off as well. So yeah, I think it's just important when you're looking at the market in general, just to sort of think about, who's doing the buying, what are they doing the buying for, and is that an area that I need to be involved in? And when we talk about this all the time, when everyone's talking about something and when it's in the news and in the headlines, it's generally in the price. And that has been the case for some time for the tech stocks. And to me, that move, which we talked about last week, but the move we've seen over the past few days suggests that the momentum trade is ending there. And I think if that is the case, if we're right on that, I think you're going to see some much more selling to come. And that could be the catalyst could be a worse than expected inflation number overnight. Or it doesn't, it might be next month's inflation number. I mean, the issue that the US and I think all developed economies have, and I've been in the camp that inflation is going to come down, but over the past few months, the more I've looked into the Inflation Reduction Act, which is the Inflation Creation Act, really, and all this money that is being pumped into a new energy system, which is effectively an unproductive, higher energy cost system for developed economies, that is inflationary. If you look at the history of economic growth, it is all about cheaper forms of energy fueling our growth. We are going in the opposite direction, which is why, just to go off on a bit of a tangent, which is why we're doing this special series on net zero insanity, because to me it is a hugely important issue for anyone interested in long-term wealth creation. And the more that we can talk about that, the more there's a potential opportunity to stop politicians going down this insane route, which is creating higher energy costs, creating a massive inflationary problem in that so many resources and productive labor is being taken away from other areas of the economy to build out what is going to be a high cost energy system. It's just crazy. So
yeah, well, I think you shared an article that you described as a pie in the sky article from the Australian Financial Review, I think yesterday, and I think it was discussing. Well, this is the first paragraph from that article that you shared, and was a fully electrified, energy efficient home with solar panels, battery, and electric cars could save its owners $3,500 a year by 2030. And 4,320 by 2050, compared with the household using gas appliances and petrol vehicles, a new report says. And you labeled that pie in the sky thinking, and I think that sort of ties into what you've been sort of all of the interviews that you've been having about the net zero and the energy transition.
Yeah, I think my frustration with that sort of stuff is that, and you missed the important bit, was that the study was modelled on. Or was based on modelling from CSIRO. And I've got a guest, hopefully going to appear on the bonus series, who did some investigative work on those CSIRO gen cost estimates and exposed some major flaws in them. And when you read about other studies that are based on those major flaws, you just wonder who's actually thinking, who's being a skeptic here. I mean, this is a huge issue for all developed economies going down this decarbonisation path, and there's not really a large skeptical movement out there saying, hang on, what are we doing this for? Is this really going to benefit us? Because effectively the decarbonising nations are just going to outsource their carbon production to other economies, or we're going to destroy our standard of living. And the other pie in the sky thing about that is that I'm not quite sure who writes these reports and maybe what their standard of living is, but it's all well and good if you live in a leafy suburb with a big house and you can put plenty of solar panels on your roof and you can afford you can afford the battery storage and you can afford an electric car
Mm-hmm.
and you can do all those sort of things, then sure, yeah, you're going to save some money, especially if the
Yeah.
state subsidizes your purchase
Mm-hmm.
of all those things. You're going to save lots of money. But I don't know, go and drive around Western Sydney, go and drive around the concentrated build-up of apartments along
Mm-hmm.
corridors of Sydney, Parramatta. That's just crazy. People aren't going to do that. And I think, you see these headlines in or articles in the
Mm-hmm.
Financial Review, which are pretty much talking to well-heeled people. And on the surface, those well-heeled people who are living in their well-heeled environments might think, okay, yeah, that makes sense. I might
Yeah.
go and do that and save myself that money. But to scale that is just insane. It's not going to
Mm-hmm.
happen. So, yeah, I just think it's important to call out those types of articles and just say, okay, on the surface, yeah, sure, great. Let's all electrify, and we don't need gas. And it's not going to happen, or if it does, it's going to come at a huge cost,
Yeah. Yeah.
much more than your 4,000 whatever saving you're going to get from. So you might save your $4,000 on electrifying, but you're going to maybe lose a job or something else along the way.
Yeah.
There'll
So
be more of a cost, is what I'm
yeah.
saying.
Yeah. So definitely stay tuned for more bonus episodes from Greg and his interviews.
Yes.
But I think maybe just bringing it back to what you were saying before, where a patient investor really has to pay attention to the fundamentals first, and have both the trust in their analysis of the valuation, also the patience to sort of go, I can sort of look past the current momentum trading and sort of say current prices may be justified by momentum, but in the long term they'll be justified by the fundamentals, and I just have to be patient enough for the gravity to sort of take effect. And I think that's sort of maybe want to talk about maybe price earning multiples and the valuations that stocks are trading at. I think there was a recent note out from Charles Schwab. I think Liz Ann Saunders wrote a note, and she said that most of the rally in US stocks since October last year are pretty much wholly attributable to price earnings multiples expansion. So people just basically being more willing to pay more for the same amount of earnings. And she's basically saying that now is the time, with earnings season really ramping up, that these earnings really have to um, match
Justify.
up, yeah, being justified. So now it's really confession season. With that said, though, I did write an article, I think, this week, that sort of had an interesting fact, and you sort of disputed it a little bit, and maybe we can get into that. But it's basically saying that uh, high PE stocks are not necessarily expensive, just as low PE stocks aren't necessarily cheap. And I think that was from Terry Smith, who wrote a few books, and I think he's a fund manager at Fundsmith. And in one of his recent books, he sort of had this amazing chart, which sort of showed that the price earnings multiples that you could have paid in 1973. Well, let me just explain. He has a quote, and he sort of explains it. So, in the period between 1973 to 2019, when the MSCI World Index produced an annual return of 6.2%, you could have paid a multiple of 281 for L'Oreal and still beaten the index. And he sort of showed that you could have still paid a multiple of 240, 230, 174 for other big quality companies and still beaten the index over that long-term period, which just goes to show that some stocks may look expensive, but over the long term, if their earnings continue to compound, they are cheap over the long term. That said, you've obviously raised a good point that this probably has a lot of survivorship bias. There's plenty of high P stocks that have either continued created or just delisted. So really, those for every L'Oreal, there's probably a dozen flops that basically just went nowhere and lost people
Yeah.
money. Yeah.
Yeah, I think it's just hindsight analysis, right? And you obviously the point you're trying to make is that a high PE stock can still be a good stock and deliver outperformance over time is absolutely valid. I guess the question is, how do you know which high PE stock is the one that's going to be the outperformer. And generally, I'm not sure if anyone is that good an investor that they can pick the outperformers ahead of time, because if you're regularly buying high PE stocks, you are going to get some losers. There's going to be some disappointers, and when the disappointments come for a high PE stock, the share price generally falls considerably. So the point's taken. Absolutely, you can. And I think when we first spoke about some of the Nvidias and the Apples, and we did the valuations, we showed that if a company is generating high returns on equity and reinvesting and not paying out as a dividend and compounding those returns year after year, then you can pay a high multiple and do well from it. But again, can you do that on a consistent basis? Can you foresee the operating environments? Can you see the competition that might come in? And that's where it gets really tricky.
Exactly.
And there's some investors that do it really well. I'm just not a growth sort of person. I don't really trust myself to be able to pick the stocks that might outperform. And certainly from an Aussie markets perspective, it's just that much harder. When you're in the US and you have the US market and also the ability to have an international dominance, they've still got to grow from a small base to get that, but you've got a very big market to start with. Whereas in Australia, you've got a market probably 1/10 the size of the US. So it's very much more difficult for our companies to get global scale and really justify those very high multiples. And I guess off the top of my head, CSL is the obvious one. That's been a global, dominated globally in its industry. But going back to your initial point on price earnings ratios and what they've done, that to me is really just it's a sentiment indicator. So when price earnings ratios are expanding and earnings are flat, that's just telling you that sentiment is increasing and people are less risk averse and more willing to pay a higher multiple for a given lot of earnings. And when that multiple contracts, that's just the opposite side of the coin. People are saying, I'm not willing to pay 15 times. I only want to pay 10 times now. And the earnings might be stable, but going from 15 to 10 times means a 30 odd % fall in the stock market for an earnings level that's stable. So that's really an indication of the effect of sentiment. And then if the market goes from 10 times to 15 times, then that's a big move as well. So sentiment can have huge impacts on the market. And really going back to just let me quickly go back to the chart of the ASX 200. It's gone sideways here, but what you want to try to do, and you can never pick the bottom, but what you want to try to do is get more, invested when sentiment starts to get a little bit worse. So here we've been through a time where sentiment, I guess it was pretty bullish up here. Yeah, it was getting bearish down here because of the Silicon Valley Bank thing. But really it hasn't done too much. So to me, you don't really want to get overly invested around these levels. You want to wait until a lot of bearishness comes into the market, because then that a lot of that bad news that might be getting talked about is priced in. At the moment, and this is why it's a pretty boring market, and it's a bit boring for our topic of what's not priced in, because there's just not a lot going on. We're in the middle of reporting season. CBA come out with a decent result yesterday. The market went up 2%. And I sort of think, I'm not even going to waste my time looking at CBA's result, because it's trading on 18 times earnings next year. Based on my valuation, it's well overvalued. You're not going to outperform by buying CBA at 18 times. And in fact, while we're on that topic, let's just have a look at the final. This
is a great chart.
I found this from the CBA presentation, because I did have a quick flick through it just to see if anything was interesting there. And to be honest, nothing really stood out from an operational perspective. But I thought this was interesting, and I don't know why they chose 2014. I think it may have something to do with this was the last maybe cyclical peak in bank profitability. So maybe the best way to do this is that the return on equity for Australian banks in 2014 was 15%. Now, on average, it's 11%. And in 2014, the average return on equity for the ASX 200 was 11%. Now it's 17%. And this chart up here shows the comparables between 2014 in Australia versus Canada, US, Europe, and the UK versus currently. So it's interesting that UK, Europe, and the US, these three here, they were still recovering from GFC, still recovering from the Eurozone meltdown in 2012. And their banking sectors had really low return on equities, whereas Canada and Australia, which were very similar markets based on housing and oligopoly, were quite high back then. And now if you look forward to where we are now, UK has recovered massively. So I dare say that their banking sector has performed very well in terms of share price performance over that time. US has improved. Europe has improved and the US has improved as well, whereas Australia and Canada have actually come off in terms of profitability. So if we think about Australia going from 15% ROE in 2014 to 11%, maybe we can have a look at this chart. I know it's a bit messy, but bear with me. So this is all the big four banks plus the ASX 200 since 2014. So Westpac has delivered negative 34%, ANZ negative 22%, and NAB down about 7%. I should say these are share price performance, so it doesn't include the
dividends
impact of dividends. So you're going to get divvies with that as well. But this is a pretty ordinary share price performance, given that the balance sheets of these companies will have expanded over the past 9 years, right? So they've underperformed massively, and that's because their return on equity is a lot lower. CBA has probably clearly maintained the best ROE of all the banks, but it's still underperformed the ASX 200. And if you remember from that other chart I showed, the ASX 200 went from an average of 11% ROE to 17%. So my point is, you only buying the banks when they're at the peak profitability or in relatively good times for profitability isn't going to get you outperformance. And what I'm always trying to look for is stocks that are going to deliver outperformance at some point in the future. And the stocks that you look for are the ones that are not in any way, shape, or form attractive right now, which was the case for the banks post COVID. I think the only time I've recommended banks was around about here. Was it? I think it was late. Might have been September 2021, something like that. And didn't hang around in them for very long, to be honest. Stayed in them for probably less than a year to get that uptick, and then when they were fully priced, it was time to move back out. Might have moved out a little bit too early in some cases, but you don't get outperformance from looking at the intricate details of CBA's result when CBA is performing very, very well. It's a very over-owned stock, over-analyzed, and it's an important stock for
Australia.
For Australia and to look at the economy and all that sort of stuff, but it's not going to give you outperformance in your super fund or in your personal portfolio or whatever. I shouldn't say definitively, but the probability of getting outperformance is probably quite low. Whereas if we want to look at where you are going to get outperformance or where there's a greater probability of getting outperformance, I thought we should, instead of just being negative about stuff, I thought it'd be good to show a couple of stocks that are looking pretty good from a valuation perspective. So this is the mining service. I've picked out a few mining services stocks. So first one here, which has done pretty well from the lows of, say, March. This is NRW Holdings. I just jotted down some numbers. So it's on a using FY24 estimates. It's on a PE of 10.5 times, dividend yield of 5.75%, price to book of 1.8 times, and it's got a return on equity of nearly 17%, and it's got a payout ratio of 60%. I should point out I haven't actually done a valuation of these, but just looking at those numbers, it looks reasonable to me. So viewers might want to go off and do their own stuff on it. And that chart's looking quite good as well. It's starting to get into an uptrend. The other stock is McMahon Holdings. This is a little bit smaller, so the chart looks a little bit weird because it trades. It's probably got a lot less liquidity than some of the larger stocks, but McMahon's on 4.4 times forward earnings, 5.5% divvy yield, trades at half of book value, and it's got an ROE of 11.9 times. So again, profitability is pretty good at nearly 12% ROE, and it trades at half of its book value. Now, the thing is with mining services stocks, they are capital intensive, so the market tends to mark these down. They're never really probably going to trade at market multiples, but as I said, you got NRW at 10.5, McMahon at 4.4, and EHL, which is a stock that I know pretty well because it's in my portfolio or in the client's portfolio that for my newsletter. It's on a forward PE of 4.7 times. It's got 6.75% forecast dividend yield, trades at a price to book value of 0.56 times, and a return on equity of 12%. So if you like the commodity sector, and we showed the uptick in commodity prices early on, I don't think commodity prices are going into any type of long-term bear market. I think there's considerable supply constraints across the whole commodities complex. These type of companies are going to do well longer term. Have a look at their balance sheets, make sure the debt's not too much of an issue. EHL does have a little bit of debt. The last couple of years, they've got that debt down a lot, but they are generating enough cash flow that they can manage that. And I think, the share price, once it moves away from this consolidation period, I think that's a buy. I don't actually have it as a buy at the moment, but I'm looking at it quite closely. And finally, this is probably the largest one. It's also got some lithium exposure, is Mineral Resources. It's on a PE of 13 times. It reinvests most of its profits, so it's only got a divvy yield of 1.72%, trades at 3.3 times book value, and it's got a healthy return on equity of 23.1%. So this has been trending down for most of the year, but I think you could look for it seems to be trying to find a bottom here. Certainly there's solid support around this level, and I think once it sort of did base a little bit and start to move up, that would get me interested. But yeah, I just thought it'd be worth pointing out a couple of stocks, Kirill, that are off investors' radars. They're looking reasonably good value. The charts are looking interesting. So yeah, be just ones to probably put on the watch list and see how they things unfold in the months ahead.
Yeah, well, if there's structural headwinds or tailwinds, if commodity prices are going to be quite strong in the long term, it's a good place to be in, to be selling shovels in a gold rush, and I think that's
Absolutely.
what mining services are. Well, I think we've talked for quite a bit. So maybe, did you have any takeaways or your biggest what's not priced in idea for listeners this week? I think you mentioned commodities.
Yeah, look, I think commodities are starting to move again, so I think that's an interesting part of the market. It's had a pretty rough 6 months, but just in general, there's no real standout, and I think that's where it comes back to your quote from the start of the show, which I'm glad you raised. Unannounced. We didn't talk about this prior to, but if things aren't, if it's not there for you to invest in, you can sit back and wait. You don't have to invest in stuff. You can afford to see how this plays out. And as we spoke about last week, I think the market is pricing in a better outcome than what probability suggests is going to unfold in the months ahead. This reporting season has not thrown up too many nasty surprises so far.
Yep.
So that's probably at least a positive. But the market multiples are reasonably demanding. So I think the companies that are delivering, they're not really seeing a big re-rate in their share price. So I think a lot of that reasonable, I wouldn't say overly good news, but I think a lot of the reasonable news is already priced in. The market isn't low enough to get those upside surprises going from good results. So for me, what's not priced in is I guess everything and nothing. It's very difficult to pull something out of the market at the moment and say here's where the best opportunities are. I just showed the mining services stocks. I think there's little pockets like that where you can say, well, there's certain areas that have just been completely overlooked. And I think you do have to go to the smaller end of the market to find that. And maybe let me just finish by showing 2 quick charts that will probably make this quite clear. So we showed this chart. Sorry, this one here. This is the real interest rate, and the market has divorced from that since the lows of last year. When I say real interest rate, this is the TIPS index, which is a proxy for the price of real rates. There's a big gap between the ASX 200 and where real rates are, but there's a lot smaller gap when you look at the small ordinaries, and the small ords have really underperformed the larger cap stocks. So potentially there's a lot more value and there's a lot more interesting stuff happening at the smaller end of the market, which has been overlooked. And this tells me that a lot of capital has concentrated into the larger end of the market, given the uncertainties around future economic growth and inflation and all those things that are unknowns. So what's not priced in, maybe a better than expected outlook for the small cap stocks.
Yeah, and I think just in live wire markets, I think one of their most popular stories, I think this week, was titled "Why Small Caps Can and Will Outperform Again." So I think there's maybe a tension starting to build for that
hang on,
sector.
then that's getting too popular, then, isn't it? So maybe that's not going to work now.
Yeah, it's in the news. Well, we'll see.
Exactly.
That's investing is hard. Investing is hard.
It is.
Yeah. So maybe to tie it all in, I think you're sort of saying that this week has been a bit dull, and I think that sometimes in this attention economy, investors may get too caught up in content and have feeling like they need to always do something or always making trades. But I think the best investors are the disciplined investors and investors that have a time frame beyond the 1 year and beyond the 1 week. So maybe there is some momentum that's pushing stocks up, and maybe you're feeling a bit FOMO, but always focus on the fundamentals. And if it gets boring, that doesn't necessarily matter. It's not necessarily a bad thing. You just have to wait it out, go read a book, go watch a TV show, and come back when the market is exciting.
Took the words right out of my mouth. I was going to say, turn the screen off, go read a book.
Yeah, exactly. I think we can maybe end on that. If it gets markets boring, read a book.
Exactly. Nice one.
Any reading recommendations?
I've got plenty. Actually, I'm reading at the moment. For anyone interested in their history, Adam Zamoyski is a really good history writer, and I've last year on holidays, for some strange reason, I picked up a book on Napoleon, which I hadn't read about for 20 odd years, and I was really interested in it. Then he'd written another one about the Congress of Vienna, which was the peace settlement after the Napoleonic Wars, which I found really fascinating. And then I saw this one called Phantom Terror, The Threat of Revolution and the Repression of Liberty from 1789 to 1848, which I can tell, some people are probably not into it all, but I'm into my history, and it's another really cracking read. But anyway, Adam Zamoyski has written loads of history books, and he's a really engaging history writer. So if anyone is into history, I would suggest checking out his stuff.
There you go. Now it's a reading book club as well. But with that said, we'll nice episode, and we'll see you next week.
Cheers, girl. See you, everyone.
See ya.
Bye.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.